Three teenage boys decide to start investing. Alex begins investing $600 every month from age 18 to 28, then stops completely. Ben waits until 28 but invests the same amount every month until retirement. Chris starts at 38 and invests even more money than both of them. Decades later, the biggest portfolio doesn't belong to the boy who invested the most. It belongs to the one who simply started first. That sounds impossible, but it's exactly how compounding works. Most people believe building wealth is about finding the highest returns. It isn't. The real advantage comes from giving your money more time to grow. Think of investing like rolling a tiny snowball down a mountain. At first, it barely changes. But as it keeps rolling, it grows larger, faster, and eventually becomes unstoppable. The same thing happens with your investments. In the early years, progress feels slow. Later, your money starts earning returns on top of previous returns, creating exponential growth. Here's a simple rule every investor should know, the rule of 72. Divide 72 by your expected annual return, and you'll know roughly how many years it takes for your money to double. At an 8% annual return, your investment doubles about every 9 years. Miss just one doubling cycle by starting late, and you don't just lose a few years, you could lose the largest growth your portfolio would ever experience. The first law of investing is simple: time beats talent. You don't need to find the perfect investment. You need to start early and stay invested long enough for compounding to do the heavy lifting. Income doesn't make you rich, ownership does. Starting early is only half the equation. The next question is, what are you actually investing in? Most people spend their lives chasing a bigger paycheck, believing higher income automatically leads to wealth. But that's one of the biggest financial myths. There are two types of money. The first is income, the money you earn from your job or business. It pays your bills, groceries, rent, and everyday expenses. The moment you stop working, that income usually stops too. The second is ownership, assets like stocks, index funds, real estate, or businesses. These assets continue growing in value whether you're working, sleeping, or on vacation. That's the real difference between being rich and becoming wealthy. Imagine two people. One earns $220,000 a year but spends almost everything. The other earns just $90,000, but consistently invests and builds a portfolio worth over $1.8 million. If both stopped working tomorrow, who would survive longer? The second person. Because income creates cash flow, but ownership creates freedom. This is why raises alone rarely make people wealthy. As income increases, spending often increases too. Bigger salary, bigger house, nicer car, more subscriptions, and suddenly nothing has changed except the size of the bills. Real wealth is built by turning today's income into tomorrow's assets. A simple way to think about it is this. Income pays for your lifestyle. Ownership pays for your future. The earlier you convert earned money into investments, the longer those assets compound and multiply. That's the second law of investing. Don't just earn money, own assets that earn money for you. Leverage can build wealth or destroy it. Now let's talk about one of the most powerful tools in finance, leverage. Leverage means using borrowed money to buy a larger investment. Imagine you buy a $400,000 home with only 10% down. If the home's value rises by 10%, you've made a much bigger return on your own money than if you had paid cash. Sounds amazing, right? But here's what most people never hear. Leverage works both ways. If that same home drops by 10%, your losses are magnified just as quickly. A small decline can wipe out a huge portion of your investment. The same thing happens in the stock market. Suppose you invest $60,000 of your own money and borrow another $60,000 to buy stocks. As long as prices rise, your profits grow faster. But if the market falls sharply, your broker can force you to sell at the worst possible moment through a margin call, locking in losses before the market has a chance to recover. That's why leverage isn't free money. It's an amplifier. It makes good decisions look brilliant, but it also makes bad decisions incredibly expensive. Successful investors don't use leverage to chase quick riches. They use it carefully, only when they fully understand the risks and can survive the worst-case scenario. The third law of investing is simple: leverage multiplies everything, your gains and your losses. Use it with caution, or it will use you. Your biggest job is staying in the game. Most investors believe making big returns is the secret to wealth. It's not. Avoiding massive losses is far more important. Here's why. If your portfolio drops 10%, you need about 11% just to break even. Lose 50%, and now you need a 100% gain to recover. Lose 75%, and you'll need 300%. The deeper the loss, the harder the comeback. Now imagine you find an investment with an 85% chance of success. Sounds almost guaranteed, right? But if you bet everything on it, one bad outcome can wipe you out completely. Even great opportunities fail sometimes. That's why smart investors never risk all their money on a single investment. Their goal isn't to hit one home run. Their goal is to stay in the game long enough for compounding to work. Protecting your downside gives your portfolio the time it needs to grow. The fourth law of investing is simple: never risk so much that one mistake can end your investing journey. Survive first, profits come later. Diversification is your greatest advantage. Let's finish with one of the most misunderstood ideas in investing: diversification. You've probably heard people say, the richest investors put all their money into one investment. That sounds inspiring, but it's also incomplete. The world's wealthiest entrepreneurs often became rich because they focused on one business they built themselves. They understood every part of it, controlled its direction, and influenced its success. But the average investor doesn't have that advantage. When you buy a random stock, you're competing with millions of investors, analysts, hedge funds, and institutions who spend every day researching that same company. Thinking you'll consistently pick the next big winner is much harder than it sounds. Here's something most people don't realize. Over the past several decades, most individual stocks have actually underperformed the overall market. Many delivered disappointing returns, and thousands eventually disappeared through bankruptcies, mergers, or declining businesses. Yet the stock market as a whole continued climbing higher. How? Because a very small group of extraordinary companies generated the majority of the market's long-term gains. Companies that started as ordinary businesses eventually became global giants. Investors who owned them enjoyed incredible returns. The problem is this: nobody knew in advance which companies would become those giants. For every success story, there were dozens of companies that looked just as promising, but failed. That's why trying to guess tomorrow's winners is incredibly difficult. This is where diversification becomes powerful. Instead of betting your future on one company, you spread your investments across hundreds or even thousands of businesses. Now, if one company struggles, it barely affects your portfolio. And if the next great company emerges, chances are you already own it. That's exactly how broad market index funds work. Rather than trying to predict winners, they simply own the entire market. Some companies will fail. Many will perform average. A few will become massive winners. Those few winners are often enough to drive the entire portfolio higher over time. This strategy may not sound exciting. There's no thrill of finding the next apple before everyone else. But investing isn't about excitement. It's about consistently building wealth while avoiding unnecessary mistakes. The best investors understand something simple. You don't need to be right every time. You only need a system that keeps working year after year. Diversification also protects you from something even more dangerous than market crashes: your own overconfidence. Every investor believes they can spot the next big opportunity. History shows that most can't. Markets change. Industries evolve. Even great companies can lose their competitive advantage. By spreading your investments, you're admitting that no one can predict the future with certainty, and that's actually a strength, not a weakness. So unless you truly have deep knowledge, unique insight, and a real competitive advantage, diversification gives you the highest probability of long-term success. That's the fifth and final law of investing: don't rely on one company to build your future. Own many great businesses, stay invested, and let time reward patience. When you combine all 5 laws, the path becomes clear. Start early. Own appreciating assets. Use leverage carefully. Protect yourself from devastating losses. And diversify so one mistake never defines your financial future. That's how ordinary investors achieve extraordinary results, not through luck, but through discipline, patience, and letting the math work in their favor. The 5 laws that can change your financial future. We've covered 5 powerful investing principles. Individually, each one can improve your financial decisions. But their real power appears when you use them together. Think of building wealth like constructing a skyscraper. A skyscraper doesn't stand because of one strong pillar. It stands because every pillar supports the others. Remove just one, and the entire structure becomes unstable. Investing works the same way. The first law taught us that time is your greatest asset. You don't need perfect timing or extraordinary intelligence. The sooner your money starts working, the longer compounding has to multiply your wealth. Every year you delay isn't just another year lost, it's one less year for your investments to earn returns on previous returns. That's why starting with small amounts today is often more valuable than investing large amounts years later. The second law taught us the difference between earning money and owning assets. Your paycheck pays today's bills. Your investments pay tomorrow's lifestyle. Many people spend decades chasing promotions, raises, and bigger salaries without realizing they're improving their income but not increasing their wealth. Real financial freedom begins when you consistently convert earned income into assets that continue growing without requiring your daily effort. The third law showed us the double-edged nature of leverage. Borrowed money can accelerate wealth creation, but it can just as easily magnify losses. That's why professional investors don't ask, "How much can I borrow?" They ask, "Can I survive if everything goes wrong?" Because staying solvent is always more important than maximizing returns. The fourth law reminded us that survival is the foundation of investing. Every investment strategy eventually experiences bad years. Markets crash. Economies slow down. Unexpected events shake investor confidence. Those who survive these difficult periods are the ones who eventually benefit from every recovery. Investors who panic, over-leverage themselves, or take excessive risks often leave the market permanently, usually at the worst possible time. The market rewards patience far more often than brilliance. Finally, the fifth law taught us the importance of diversification. No one, not even professional fund managers, can consistently predict tomorrow's biggest winners. Instead of trying to be right every time, successful investors build portfolios that don't depend on a single prediction. Diversification accepts one simple truth. You don't have to know the future to build wealth. You simply need to own enough great businesses for time to work in your favor. Now notice something interesting. These 5 laws aren't separate ideas. They form one complete investing system. Time creates growth. Ownership gives your money something valuable to grow. Leverage determines whether you accelerate that growth or accidentally destroy it. Risk management ensures you survive long enough to enjoy decades of compounding. And diversification protects you from the uncertainty that every investor inevitably faces. Miss just one of these principles, and the others become much less effective. For example, compounding can't help if you constantly sell during market crashes. Ownership doesn't matter if you borrow so aggressively that one downturn wipes you out. Diversification won't save someone who starts investing 20 years too late. Every principle supports the next. So before making any investment, ask yourself these 5 questions. First, can this investment realistically grow over the next 10, 20, or 30 years? Second, am I buying an asset that creates value, or am I simply spending money on something that loses value over time? Third, am I taking on more debt or leverage than I could comfortably handle during a major market decline? Fourth, if this investment drops 30%, 40%, or even 50%, will I still be financially and emotionally able to hold it? Fifth, do I truly understand how this investment makes money, or am I buying it simply because everyone else is talking about it? If you can't confidently answer these questions, you're probably making an emotional decision rather than a rational investment. Successful investing has never been about finding secret stocks or predicting the next market boom. It's about making consistently good decisions, avoiding catastrophic mistakes, and giving yourself enough time for those decisions to compound. Because at the end of the day, wealth isn't built by chasing every opportunity. It's built by following a simple system, sticking to it through good times and bad, and letting patience do what excitement never can. That's the difference between people who constantly chase money and people who quietly build lasting wealth for decades. The truth about building wealth. Let's end with a simple question. If I gave you 2 investors and told you one earned higher returns while the other simply followed a better system, who do you think would be wealthier after 40 years? Most people would choose the investor with the higher returns. History says otherwise. The investor who consistently follows the right process almost always wins. Because investing isn't a competition to make the fastest money. It's a game of making the fewest irreversible mistakes. That's the lesson hidden behind every great investor. They didn't become wealthy because they predicted every market crash. They didn't always buy at the bottom. They didn't always sell at the top. And they certainly didn't win every investment. What they did better than everyone else was remarkably simple. They stayed invested. They controlled risk. They ignored distractions. And they trusted time to do the heavy lifting. That's why the greatest advantage in investing isn't intelligence. It isn't luck. It isn't having inside information. It's discipline. The discipline to keep investing when markets are falling. The discipline to ignore headlines screaming that the world is ending. The discipline to continue buying quality assets even when everyone else is afraid. Because every major market crash in history has eventually been followed by new highs. Every recession has ended. Every bear market has passed. But the people who panic usually lock in losses while the patient investors own the recovery. Now think about the 5 laws we've covered. Law 1, give your money time. Compounding rewards patience more than talent. Law 2, don't just earn income. Build ownership. Assets should eventually work harder than you do. Law 3, respect leverage. Used wisely, it can accelerate wealth. Used carelessly, it can erase years of progress overnight. Law 4, protect your downside. You don't need to win every investment, you simply need to survive long enough for the winners to matter. Law 5, diversify intelligently. Never let one prediction decide your entire financial future. Notice something incredible. Not one of these laws depends on predicting the stock market. Not one requires finding the next trillion-dollar company. Not one relies on complicated trading strategies or secret indicators. They're all based on behavior. And behavior is something every investor can control. You can't control interest rates. You can't control inflation. You can't control elections, wars, recessions, or what the market does tomorrow morning. But you can control how much you save. You can control how consistently you invest. You can control how much risk you take. And you can control whether fear or patience makes your decisions. That's where wealth is really built. Most people spend years searching for the perfect investment. Successful investors spend those same years becoming the kind of person who sticks to a great investment strategy. That's a huge difference. Here's another truth that rarely gets talked about. Your portfolio doesn't care about your opinions. The market doesn't reward confidence. It rewards consistency. It rewards patience. It rewards people who continue investing year after year, decade after decade, regardless of what's trending online. The biggest fortunes aren't usually created in exciting moments. They're created during thousands of ordinary days when someone quietly continues investing while everyone else is distracted. That's why investing often feels boring. And that's exactly why it works. If your investment strategy needs constant excitement, constant predictions, and constant action, it's probably not investing. It's speculation. Real investing feels slow. Sometimes it feels like nothing is happening. Months go by. Sometimes years. Your portfolio grows little by little. You wonder if it's even worth it. Then one day you look back after 20 or 30 years. And realize those small, ordinary decisions completely changed your financial life. That's the power of compounding. It rewards people who refuse to quit before the miracle happens. So before you make your next investment, pause and ask yourself these 5 questions. Will this asset still have value 10 or 20 years from now? Am I buying something productive, or am I simply chasing hype? If this investment falls by 50%, can I emotionally and financially hold it? Am I risking more money than I can afford to lose? Do I truly understand why this investment should become more valuable over time? If you can't answer those questions honestly, wait. There will always be another opportunity. The market rewards preparation, not impatience. And remember this above everything else. You don't have to become rich this year. You only need to become a little wealthier every year. Small improvements repeated consistently create extraordinary outcomes. That's true in investing. It's true in business. It's true in life. So start now. Start with whatever amount you can afford. Ignore the noise. Own great assets. Stay diversified. Protect yourself from devastating losses. And let time become your greatest business partner. Because one day, years from now, you'll look at your portfolio and realize something. The money didn't make itself overnight. It grew because you made one simple decision. To start before everyone else, stay invested when others gave up, and trust a system that has rewarded patient investors for generations. That is how ordinary people build extraordinary wealth. And that's why these aren't just 5 investing rules. They're 5 principles that can completely change your financial future.